Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, March 26th, 2022. It's been another great week of shows, and we kicked off the week with a discussion around whether recent events and inflation have changed investor sentiment towards ESG and sustainability. Let's take a look.
Yes, well, the inflation story and what's happening with the Fed, that's one strand, and I don't know how much that directly gets into ESG and so on. So that's a whole interesting conversation. But of those two, I think the one which has really raised some interesting questions around ESG is, as you say, the issue with the Russian invasion of Ukraine and some of the knock-on effects of that. And the first thing to say about that is, I'm not an expert on geopolitics, and very, very few people working in the investment industry are. Yeah. And so, you get a lot of webinars from asset managers and so on. And it's important when you're listening to, whether it's me or any of these other talking heads from the industry, to not to think of us as experts on the geopolitics of it. We don't know what's going to be, what's going to happen in terms of the war and so on, any more than any educated individual watching the news would do. But where the industry is obviously strong is, how does that feed through into markets? How does that affect portfolios? What might we do about it? But the industry struggles sometimes with the fact that it's not an expert on something. We like to deal with inflation, what the Fed's doing, things that we understand and we know as much as anybody knows about. But when it comes to something like a war, we're in the same kind of fog of ignorance as the general population, and the industry doesn't always like that. So you've got this huge uncertainty going on. But the one thing that we do know with Russia being involved here and the sanctions and so on is it's got huge implications for energy, and that's especially true if you're sitting in Europe, where a substantial proportion of the energy is being supplied from Russia, and you just can't cut it off like that without there being huge implications for how do people even heat their homes. It's a big issue for the US as well. There's some Russian oil coming in, so it's not quite as in your face for the US, but it's still it's a really big deal, and that has implications in the short term, and it has implications in the long term. So just looking at the ESG implications in the short term, I've already heard people saying, "Oh, does this now mean that defense stocks are actually socially responsible stocks in this context? We need a military. Do we kind of flip our view on whether investing in weapons manufacturing and so on is a socially responsible?" And that's an opinion. You can take one view, I can take another, and that you can build the case either way. So I think it's starting to raise some short-term questions around what is and isn't green, and then you get the whole energy debate. And so one issue that's massive, for example, is nuclear energy a green energy, or is it a dirty energy? And again, you've got fundamental disagreements between well-educated, informed people on that, and you can take your stand. So that's the short-term implications. But then there's a long-term story, and this I think is where the ESG story is really the clearest part of this. Long run, oil is, if we're successful in making the energy transition that science says we need to make, oil goes away. We have to stop burning oil. We have to find other sources of energy, and they're out there in the long term. There's a lot of solar power potentially. There's a lot of wind power. There's power under the sea. There's a lot of power. We need the technology to harness that. And so long term, I think it really underlines the extent that the energy transition is needed, not just for the sake of climate change, but we need an energy transition partly also to reduce our reliance on, it's not just, Russia's not the only regime that's very oil dependent that perhaps we'd rather not be as dependent on as we are. You can look at Venezuela, you can look at other oil producers that perhaps we'd rather not be as closely tied to them as we need to be at the moment. It's much harder to invest in order to beat inflation than it is just to earn a return. And that skill of finding an exposure that's going to rise more quickly than prices rise is a skill which has maybe been lost in the industry, and certainly the public's experience of inflation is very much, it's a generational difference. You've got this whole generation of investment professionals today, none of whose careers have really spanned, with a few, only the old guys and the old gals have invested in times where inflation was a real concern, because it's not been a big issue now for a very long time. And so that is, it's a new experience for this generation of investment professionals, and we're perhaps going to see a lot of learning going on that, Grandpa understood this stuff because he was investing in an inflationary environment. That's just not the environment that this generation has grown up in. So I think it's going to be a challenge. And I think that's exactly the point. And it's possible to characterize ESG as just being a reminder that everything is ultimately connected. We're not playing a game that's just looking at the money unconnected from how the businesses are operating in this world, from other real world things, wars, climate change, and so on. Things are much broader, much more connected, much more complex, if you like, than perhaps a simple economic models would say. So I think you're exactly right. This is just about reminding ourselves that what we're doing is connected to a bigger economy and to a bigger world, a bigger community, even beyond the pure economic issues. And that's the world. That's what we're living in. And that broader world has implications for the investment decisions we make, and vice versa. The investment decisions we make have implications for the wider world, and we ignore those interconnections at our peril.
We also discussed why retail investors are dropping out of the stock market. Let's take a look.
Yeah, I think it's a kind of a 1-2 punch, if you will. You've got people really going back to work. And so, they've got a lot less time on their hands to be speculating in the market. I also think that the, big sort of like exuberant joy and excitement and interest in retail investing has kind of gone away. There are, of course, still meme stocks. I mean, you see what, AMC recently did, buying some mining company for whatever reason. So that's still happening. But I think that largely the bulk of that interest and, this sort of like gold rush, if you will, to grab any alpha that they possibly can has really tempered. And so I think you're seeing people starting to buy things and hold on to them for the longer term. There's a lot of worry, of course, about what's going on with Russia and Ukraine and other areas around the world. And so I think retail investors are kind of taking a bit of a breather right now, reassessing the landscape, really figuring out what exactly their investing goals are, why they're investing in the first place. And then they'll, maybe make some strategic moves after the fact. But I think a lot of people are just sort of, sitting around waiting and seeing, and are now preoccupied with other things. Yeah, absolutely. I think, I'm always at war. I have two sides of myself. I have the financial planner side, which is, buy and hold long-term diversified portfolios of ETFs. And then I have the former hedge fund analyst side, which believes in active investing in inefficient markets. And so I think there is a place for both in somebody's portfolio. I think, when you're investing for something that's very long-term or incredibly important, meaning like if you lost that money, it would really not be great. Then yes, a diversified portfolio of ETFs and buying and holding is probably the better strategy for you. But that's not to say that there aren't opportunities in the market that are shorter term, meaning anywhere from 6 months to 5 years away, where you could generate outsized returns to achieve very specific financial goals that you're investing for. And so, on the one hand, yes, I love that people aren't just throwing money at the wall or throwing spaghetti at the wall and hoping something sticks and they become a millionaire overnight. But on the other hand, I think that there's still opportunity there, and you're still seeing investors, engaged. But ultimately, I think what it's going to result in is sort of sort of a reckoning for the companies who are generating revenue via payment for order flow, like Robinhood, for example. They did incredibly well in 2020. Their accounts, increased tremendously, as did their bottom line. Top line, not necessarily bottom line, but now, you look at their fourth quarter results and guidance, and they're a little concerned, I think, about the trading activity going forward. Yeah, I think the inflation impact on retail investor behavior is really fascinating because, as somebody who I'm in California, our gas prices are over $6 a gallon right now. It's absolutely bonkers. And wage inflation is not keeping up. And so you've got sort of this weird, dual components at odds here where it's like, well, you've got these inflationary pressures. People may not have as much discretionary income because they're, having to pay so much more for groceries, gas, et cetera. But they're also on the other side thinking like, how can I possibly afford my lifestyle going forward, hoping that my company increases my salary enough over time to cover these expenses. And so actually you've got less discretionary income, but perhaps more interest in investing as a way to be able to afford the things that they want to afford. And so, yeah, it's kind of interesting. You see some people that are terrified. And so they're staying out of the market and just hoarding cash as much as possible. And then there are other people that are like, well, geez, if my gas bill has gone up this much just to commute to and from work, my company's not paying me anymore. I should maybe look to invest some of my cash in order to help, cover this additional expense. So it's really interesting, the kind of two camps that we're hearing from, and it'll be fascinating to see how that shakes out. Yeah, I think it's interesting to in times where things are great and you maybe have more time to think about the, potential climate impact of your investments and what's actually in your portfolio, you can be a bit more strict about maybe, what's in your portfolio. I don't want to invest in fossil fuels. I don't want to support those companies, especially not any in the United States. We need to catch up and not produce our own oil and think about going more green and what have you. But then now all of a sudden it's like, oh, well, we haven't done that and we're not getting oil from other places that we deem to be okay to source oil from. So actually, maybe we should be throwing a little more money at those companies to produce more domestically. So there is a bit of a switch there, but I do think long term, this new generation of investors, especially, are very concerned about where their money is going, even though they're not directly, they're not like actually giving that cash to those companies directly. It's a secondary market, but they do feel as though they're kind of voting with their dollars. And I don't think that's going away anytime soon. And we see a lot of additional startups popping up that have more of an impact focus for retail investors.
We're halfway through a look back at some of our best segments of the week. You're going to want to stay tuned for the other half right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
It's not some magical number, and it's not something we just achieve at the end. It's a feeling of freedom to live our lives the way we intended, through the ups, the downs, all of it. This is financial security. And Lincoln Financial Solutions will help you get there as you plan, protect, and retire. This is Lincoln Financial.
Welcome back. We also discuss some higher education lessons from Peloton. Let's take a look.
Great. Well, looking forward to speaking. I'm not sure that higher education should look exactly like Peloton, but we can get into this. So I think the big question we all have now is, what are things going to look like after the pandemic? What have we learned? What can we take forward? And what can we do differently now that the pandemic is hopefully ending? Sure, great. And I experienced this also as a dad, as a parent. I had my daughters come home and live at home and try to finish out their senior year and start graduate school during the pandemic. And it wasn't great, right? Like it was a hard situation for everyone. And one of the things that we learned during this pandemic is how important that residential experience is, how much we all want to be and need to be together on our campuses. So I think some of our lessons are, well, how can we keep that core residential experience, but also bring some of the affordances of digital technology so that we can be resilient, say, if another variant spikes or we have extreme weather events, and also how we can improve online education for those people not like my kids, not like my daughters, who are working full time, who have jobs and families who really can't quit their jobs and can't move and be on campus to get their master's degree, say, and want to keep working and studying at the same time. Yep. I think that brings us to some of the lessons about Peloton, which I think are interesting lessons. And it's important to separate the story of Peloton from the bikes that so many of my friends and colleagues love and have a great time, and the company. Yeah. And what I was really writing about is the challenges that Peloton as a company has had in their business model and their stock price that went way high during the midst of the pandemic and have really crashed down as people have started to come back. I think the big lesson here is that, like with Peloton, the biking at home is only going to have a part of people's fitness. People still want to go to gyms. It's not going to replace, Peloton will never replace the experience of going to gyms. And I think Peloton and the investors thought, well, this is what would happen. It would just keep growing and keep growing. I think some of the lessons here for online and remote education is it will complement residential and face-to-face education. There is room for both, and we need to have both for the reasons that you talked about. You really can't replace so much of what you get on campus in a face-to-face residential campus environment with online learning. Yeah, I think like with every technology, we have to use it appropriately and think of our goals for using technology. So if you're fortunate enough, like I was fortunate enough as a dad to send my kids to a residential education, that they have that experience in that 18 to 22, that's wonderful. That's the minority of all learners. Fewer than 1 in 5 undergraduates actually have that residential on-campus experience. Most of our learners in this country are adult learners. They're working, they have families. They don't have the luxury of the residential experience. So what we need to do is say, okay, that residential experience is wonderful. We need to keep that. We need to augment that. We need to invest in that. At the same time, we have to improve the online experience for those learners where that works best, where online works best with their families and their work. We're going to see rapid growth in master's degrees, in particular, as master's degrees are the new undergraduate, in low residency, hybrid, and online learning. And I think we've learned a great deal during the pandemic of how to do that sort of learning better.
And finally, balancing caregiving, family, and your job. Let's take a look.
Right, she's doing in-home hospice. Hospice typically means that they've given you 6 months to live. She's just now thankfully eclipsed the 6-month window. So now she's into her second 6-month window. And, I think for my mom, I think for the family, it's a good thing because she's still with us. For her personally, I don't know. She feels this has been going on for a while, but I know as I observe my mom, maybe this is too much information, but she's actually feeling a little bit better because she's doing at-home hospice. So we're trying to make her as comfortable as possible. And it seems as if, it's been beneficial for her doing at-home hospice. Right. I mean, she's on her own schedule being at home. When she was in assisted living, they were almost doing daily COVID tests, and she was tired of having to go through that ordeal on a daily basis. And, the nurses were on their schedule. Here at home, she's on her schedule. She sleeps till she wants, lights off when she wants. And I think that works for her. Yeah, it's not easy, I'll tell you, especially because, my mom requires 24/7 care. She's not the most demanding, but still, there are times when her caregiver needs time off. So I spend my time with her. So I'll spend, 3 or 4 days a month living with her, taking care of her. And I am sort of fortunate that I'm in the financial services industry. If I was in construction, I'd have to be on the job site. So for a lot of our clients in my industry, we're still working remotely or we're doing a lot of Zoom or Teams calls and things like that. So all I really had to do was get high-speed internet at my mom's residence and bring my laptop, and I'm able to work from there. So the only time for me it's a bit of a problem is when it's just myself and my mom, and I'm doing a call with a client or what have you, and my mom's calling me at the same time. So that's a little bit, could be a little bit stressful, or someone's ringing the doorbell or what have you, things like that. But fortunately, it's worked out. But right, and it is difficult for, I think, some folks. And I can convey a story. I have a friend who their employer actually let them leave work for 6 months with full pay. I don't know if that wasn't an option for me. I mean, I don't know if during the labor shortage or what, for whatever reason, I still kind of have to work, but I'm able to do my work. So I actually find myself, when I'll use the term sequestered, living with my mom, I have a lot more time, a lot less distractions, so a lot more time to focus on my work. So in some ways it's a positive for my employer. The only time, like I said, if there's a distraction during a client meeting, but aside from that, we are making the best of it. Who knows how it'll all work out in the end if my mom becomes too much of a burden to take care of. But right now, we're as I said in the beginning, we're taking it day by day, and it really does. That's the only way you can handle these situations. Just trying to make my mom as comfortable as possible.
Well, great segments. I want to thank all of our wonderful contributors this week. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more in all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content? Search our archives, check out our website, and also our streaming partners, Amazon, Roku, Samsung, over 100 more. We're back again tomorrow for BRN Sunday. We'll be taking a look at some of the recent events and news with members of the media, academia, and financial services. You're not going to want to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a tax doctor now for a tax emergency analysis.
Call 800-224-6439.